Okay, welcome everyone. Hopefully you are all seeing and hearing me. Welcome to today's webinar. It's great to have you here. We've had fantastic interest in this event, over 250 signups from over, I think it's 22, 23 countries, 5 continents. So we truly are global today. So thank you very much to Grez for co-hosting this and for sharing the message to get people here. Thank you also to the team at Evora for doing the same. For those of you that don't know Evora, we've been operating now for 14 years as a specialist advisor to real asset investors. We're around about 150 people strong, and we're across North America and Europe. My name is Ed Gavitas. I'm one of the co-founders of the business. I'm head of North America and based in our New York office. And really our mission is simple. We try and provide end-to-end advice to help our clients to reduce risk and enhance the value and reputation of their real estate portfolios and assets. We do that through a variety of means covering strategy, decarbonisation and active asset management, sustainable finance, and importantly, as we have Grez here today, we do a lot of reporting, around about 10% of the global submissions each year. So I'm delighted to have you here today. The goal that we're going through is really to hear from 3 leading organisations, which I'll introduce shortly, to hear how they are using active asset management to drive demand for buildings and deliver sustainable value creation. Now, why is it that we're talking about that? Well, although we're seeing some signs of the market bottoming out and some cap rate stabilisation, it's no surprise that returns have been hit in recent years. And that's been due to a combination of factors, particularly the era of high interest that we've experienced compared to, say, 2008 to 2022. And equally, there's been a hit in terms of occupancy, and there's been some declining values in some areas. So generally speaking, when you have high interest rates, it's harder to make leverage accretive to returns. In simple terms, when it's cheaper to borrow, you could borrow more, you can buy more buildings, you could buy more expensive buildings, and you can use finance to drive returns. The trends that we're seeing now is that people are really having to focus on active asset management to drive through a number of benefits, which might be reducing costs, it might be avoiding penalties and potential discounting, it could be increasing revenue and improving liquidity. Ideally, it's all of those things. And I think sustainability has the ability to support across all of those outcomes. And that's what I want to hear from the panel today, is really about the trends that they're seeing in the industry, what they specifically are doing to take advantage of this opportunity or to mitigate risks. And then finally, what can we all collectively do to get better so that we can drive more change and do that sooner? This is an interactive session, so there is a Q&A button on the bottom right of your screen. Please do submit questions. Thank you for the questions that were submitted as part of the registration. We're going to pick up on those as best we can. And I'll be checking in as we go through the session to address any new questions that we have coming in. So please do post them. Plenty of people on the call. So that's enough for me. With that, I'd like to introduce my 3 guests who are going to help us deliver against that goal. So I will start off by coming to you, Kathy. If you could please just give an overview of who you are and where you've come from.
Thanks, Ed. Hi, everyone. Thanks for joining today. I'm Kathy Thurston. I am co-lead of our sustainability program at PGIM Real Estate. We're a global investment manager with investments in many markets, Europe, Asia, and the US. My role is covering our sustainability strategy for our debt and equity programs, primarily in the US, and advancing our approach to sustainability at the asset level for our equity business, as well as assisting our borrowers and stakeholders in our debt business and understanding what they can be doing around sustainability and how we work with our borrowers to help them achieve their goals.
Great. Thanks, Kathy. And that's certainly something we want to pick up on later, is both the equity and the debt side. Eilidh, I'll come to you next, please.
Thanks, Ed. Thanks so much for having me today. So I'm Eilidh Roberts. I'm the Global Head of Sustainable Investing with BGO. We are also a global real estate investment manager with equity, debt, and secondary strategies. We have 83 billion in assets under management and operate in the North American, European, and APAC markets, with about a half of our portfolio based in the US. Similar to Kathy, my role is also supporting BGO's sustainability strategy, supporting the different investment strategies that we have across the risk spectrum, to align the sustainability goals with their financial objectives as well, and also engaging with our investors to ensure that we're aligned with their priorities and the priorities of the markets that we're based in. So great to be here today.
Fantastic. Thanks, Eilidh. And Chris, finally to you.
Absolutely. Hey, Ed and everybody else, thank you for the chance to be here. I'm Chris Pike. I'm the Chief Innovation Officer for GRESB. And as many of you guys know, GRESB is a Dutch company and a Dutch foundation. And I'll tell you more about the foundation in a few minutes. But basically, I work at GRESB because I believe that there is the potential to drive positive change through constructive engagement between institutional investors and asset managers. So my big punchline for this introduction is I'm a scientist. I work in real estate because I think we have the potential for positive impact through constructive engagement. And I'm excited to talk about how that creates value and mitigates risk.
Fantastic. Thank you, everyone. Well, Chris, it sounds sensible if we stick with you. You've been on the road there quite a bit recently, meeting a lot of the foundation members that you've mentioned. It'd be great to hear, but what are you hearing? What are you seeing as it relates to some of the risks, the challenges, the trends, and and how people are thinking about that?
Yeah, it has been a busy month, and let me share a little bit of perspective. So I'll for the purpose of this answer, I'll focus on the foundation. And so if folks don't fully recognize, GRESB is a very unusual private company. We actually have given, as part of how we're structured, all of the intellectual property, basically the standards, what they are, is controlled by a nonprofit Dutch foundation. Today, that foundation is 144 volunteers strong, 41 of them from EMEA, 28 from the Americas, and 25 from APAC. So we truly have a global constituency. Even though I have some responsibility for supervising that foundation, I don't get a vote, nor do any other staff. So basically that foundation is the governance body for the indicators, the metrics, and their weights in the various GRESB standards, both real estate and infra. So that's what we do. And so we are excited about growth areas, and we'll talk to you about that. And so what we think as a foundation that does is provide a global language to provide standardized data. So the first thing we're doing is giving people a language to collect both indicators and metrics. We hope that we're providing comparable scores over time and benchmark ratings so that companies and investors can compare themselves. That's what we think we do. So last week in London, we brought together more than 40 of those foundation volunteers to talk about the future of the standards. And I'll just mention three things that were cross-cutting themes from both the institutional investors and the asset managers and our partners, who are groups like the Green Building Council of Australia or the Property Council of Australia or EPRA. So to give you a sense of what that is like. So I'll give three things. One, there was a cross-cutting sense that we need to evolve the rating approach to go beyond sort of statistical divisions of the marketplace to provide some better rules about what constitutes a high-scoring company or fund, and to better support emerging investment strategies, both green to green, when we're investing in green assets and managing them for a green exit, brown to green or transition assets, and other kinds of strategies that are becoming more important in the marketplace. So there's a need to evolve both the scores and the ratings to do that. The second one is we also understand that the market has become more sophisticated, and there is a need to partition between fundamental practices, things that everybody should be doing, whether it's governance, management, policy, and things like performance metrics that are perhaps harder to achieve, but also maybe more meaningful on the ground in differentiating assets. And at the end of the day, we understand there's a cross-cutting global imperative to make these things relate back to business fundamentals. How are we creating value increasingly on exit, increasingly from the idea of what the next buyer of that asset is going to value, and how do we avoid risk, whether that's regulatory risk in the sense of energy efficiency benchmarking or physical climate risk. And so really relating those things back to our core proposition of increasing asset value, reducing investment risk, and helping investors have a more predictable outcome over time. So I think when we brought together 40 people, that's what we heard. And so we are kind of digesting some of those things and trying to reflect that in the evolution of the standards.
That's great, Chris. Thanks. It's hard to disagree with any of the motivations behind those outcomes. And maybe Aili, coming to you next. You operate across the spectrum of investment strategies, from core funds to value add and other. So that green to green approach, the brown to green, is probably something that chimes with you, how you implement your processes and strategies. It'd be interesting to hear, in what ways BGO has changed in the last, say, 5 years as it relates to identifying and mitigating some of those risks that Chris was talking about.
Yes, absolutely. I think, things that have remained consistent are the real estate fundamentals. As a fiduciary, we are here to help create value with our investments and mitigate risk. And what those risks are really depends on the materiality to that fund and to the markets that we operate in. We're still very much, monitoring things like tenant attraction and retention, really focused on asset obsolescence, but things that can impact those risks are the things that I think we're going to talk about here today. What is most material to our investment? So, in terms of how we're looking at this throughout the investment life cycle, it's become standard practice over the last 5 years to really focus on integrating and assessing sustainability risks, starting off with acquisitions and the due diligence process. We've gone quite a lot more sophisticated in terms of the level of detail to which investors are looking into these risks. Early on in that process, we're really focused on identifying low-hanging fruit energy efficiency opportunities to help reduce our operating costs and lead to NOI growth. This certainly is something that, regardless of your sustainability goals, as an investment manager or even as a tenant, this is something that can resonate with future buyers and also with our tenants to help reduce our operating costs. Climate risk is certainly top of mind, given everything kind of going on in the world. Integrating climate risk assessments using third-party data providers, and when those high risks are identified, doing additional investigations of what is maybe leading to that risk at the site, and understanding the asset vulnerability as well. In terms of how that's being built into underwriting, I think that's where there's a bit more inconsistency in the market. Whether it's being reflected in underwriting or in the terminal cap rate or even in the cash flow models, that really remains to be seen as a consistent practice. And I think we're really seeing that market by market. Stranding risk is, of course, another important area of consideration. Certainly within the European market, we're seeing things like minimum energy performance, or EPC ratings, become a very material risk to the asset leasability, or leasability and also the liquidity of the investment as well. So these types of things, market regulation is certainly prominent as well across the US as well as Canada. Certain markets have financial penalties, and we're really trying to understand the impact of those to our investment strategies. So we're looking to make sure that the investment strategy really reflects that, and we're building in the appropriate CapEx to address those risks to mitigate that liquidity risk on exit.
Fantastic. So lots of things to unpack there in terms of the risks and approaches that you do. Maybe just one question I had would be helpful to share with everyone here on materiality. So one of the aspects of active asset management is having really good local insights and knowing what it is you need to do. In terms of your approach to that, do you think about materiality, regionally? Is it market or sector specific, or is it actually, down to the individual asset?
I think it's a combination of all of them. It does depend on the asset class as well. So we're looking at, within the market, we're looking within the asset type in that sector. And then we're also looking at what is going to be most material to, the future buyer as well. So I think it can really span across all of those categories.
Thanks, exciting. And then maybe Kathy, be great to hear from you, and anything that you have to build on what we've heard already, but particularly, how are you navigating your approach with a very broad range of investors, and particularly those that may have different stances on these topics?
Yes, I think you'll hear a lot today. We'll talk about transparency and really being open with what's important and what is material. And I think what we've seen is today's environment, and really the environment we've been growing into over the past several years, requires asset managers, requires owners, developers of real estate to be very well versed on sustainability topics, to speak with their stakeholders, including investors, because you really need to manage the spectrum of not only investor preference, but we're now seeing, a high degree of sophistication across investors in their knowledge of basic sustainability factors, I would say, even down to the asset level. And some investors may want to engage very deeply with their product managers on what they're doing at an asset by asset strategy level. Others may be more neutral on the topic. They just want to know that their investment manager has covered the bases, that they've got their eye on what they need to, and they're fulfilling their fiduciary duty and not, going beyond that. But being able to speak that language across the very wide spectrum of investor preference is extremely important now more than ever. So we work really hard to meet our investors where they are on the topic and help them understand how we're managing and fulfilling their fiduciary duty, our fiduciary duty, and protecting them from risk. And it's a lot of what Eiley was speaking about. It's understanding that your views from your investors in Europe, from Asia, and the US, depending on where they're from, they may be coming from different places and need more transparency, more KPIs, more deeper understanding. Maybe they're digging under the hood of GRESB and they're looking at every last little thing that you're doing and reporting across your products. But I would say overarchingly, we find that as investors crisscross the globe, they are looking for us to mitigate that risk, be it physical risk, transition risk, and they want to understand, how are you thinking about portfolio construction? How are you protecting them from clusters of risk if they're investing with managers in multiple regions? So a lot of what Eiley was saying, it kind of gets down, it cuts across from a regional perspective down to asset level location and needing to understand all of that.
Mm-hmm. I think that's great. I think that's strong messaging on consistency. You mentioned about KPIs, which is another area that can help provide consistency and comparability across different assets. And this was a question that came in through the registration around, what are the most important KPIs? And open question, but maybe Chris, GRESB has a lot of KPIs. There's a lot of data that goes in there. Like, anything to add in terms of what you are seeing now, but also in the future as the most important KPIs as it relates to benchmarking and risk mitigation?
Oh, Ed, thanks for sharing that question from the audience as well. But it's such a difficult question to answer. I think right now, to what Kathy just said about the breadth of investor interest. So I think that clearly there is a heart and soul of core KPIs. We all understand energy, emissions, water, possibly waste, along with key fundamentals about asset size, location, utilization, occupancy. Okay, there is a nucleus of KPIs. As you begin to depart from there, investors are so divergent in what is material to their thesis that we really see a gap. And just to be very tangible about it, a couple of our investor members are, hey, they are pure play energy and emissions. That's what they care about. And then the rest of it, they don't, that's it. Pretty much that's their KPI. On the other hand, we have others who are leaders on the foundation board who they regularly use more than 40 different indicators each year, and those are what they use as their engagement framework. So there's not a right or wrong answer between 2 and 40. I think that there is a consensus that we want to do more with less, so a smaller number of higher quality metrics. So I don't think we're going to a world with vastly more metrics, although there is pressure when it comes to things like climate risk and resilience that maybe we don't have the right metrics yet. But I don't see the envelope of metrics expanding rapidly. I see us trying to focus on fewer, higher quality, richer interpretations of those metrics. But I can't tell you it's only this core. We can go down the road of valuation, which is kind of a special area where you could say, hey, what are the KPIs for valuation? We can pick that up if that's of interest to anybody. But I'd love to hear from others if maybe I'm being too conservative, but I see a spectrum of KPIs that we're working on today.
Kathy, Ali, anything to add on that piece in terms of favorite KPIs or even the barriers to producing KPIs?
Actually, we go two ways. You can stack rank. You can say these are your favorites, and then my favorite game is to take the bottom 3 on the GRESS list, give them a cigarette and a blindfold, and send them out. But that's a separate issue.
I would agree with Chris's sentiment that it is trying to strike that right balance of what are the most material metrics that we need to report, and considering your stakeholder constituents and listening to them in understanding that they have their own purpose for looking at these metrics, either reporting or regulation that they're looking to answer or fulfill. And so, we tend to focus on the big ones, as Chris mentioned, energy, water, waste, but for all of the big common metrics that we focus on, there's just as many that our investors are interested in. What's happening with biodiversity and how are we addressing it? And let's not forget biodiversity. And so, I think managers are consistently challenged to be able to express to investor what you're working on, what's coming next, what you're trying to get transparency to them on, and communicating that we understand the importance of the information that they're seeking to get at the asset level. And so it's about continual improvement too. But it would be much appreciated if we could hone in on a set of metrics that everyone could live with.
Yep.
Couldn't agree more. Couldn't agree more. Like I think, both of you have reiterated, the different KPIs that we have, may differ depending on the stakeholder group that we're talking about. So there is an element of education as well, even in terms of the comparability of some of the KPIs and the underlying methodology. It's important that our stakeholders are understanding what exactly we're trying to communicate and how that's derived. Just to kind of touch on a few KPIs that maybe we haven't mentioned, things like data coverage or even building certifications, a labeling sort of scheme do remain sort of relevant in the market as sort of key indicators of how our assets are performing. So better quality data and more transparency, Kathy, as I know you mentioned, are really key to helping communicate that with our stakeholders.
Thanks, everyone. Yeah, I think it's so important to think about the outcomes that the KPI is enabling and making sure there is a point to that data piece, that it's informing a decision, tracing it all the way back to the origin. And if it's not delivering any particular outcome, then you need to question why are you going through the effort of collecting the data and bringing it to people for them to analyze. There's a question that's come in that's picked on a little bit earlier, and it's very challenging to answer. So there are some KPIs where it's easier to look at, is this a good decision or not, in a very constrained and short-term manner. So ROI, you can go, does it stack up? Does it pencil in my hold period? Yes, well, it's a no-brainer. No, we need to think of other reasons to make that decision in terms of the next owner or future compliance. But one area that would really meaningfully help to influence decisions is around the impact on terminal cap rates, and there was a comment earlier on this. But it'd be interesting to hear, maybe Chris, you're hearing or seeing how people are doing this, whether it's anecdotal changes, it's gut feel changes, it's more, empirical around they're making these assumptions. But anything to share around how people are thinking around?
Actually, I'm equally interested in what Kathy and Eiley have to say about it, because we're all involved in this, terminal exit value and terminal cap rate or sort of conversation. I think so. The question that was posed by the audience was basically, can you rely on a cap or a discount rate as an indicator of perceived risk versus a bundle of KPIs or something like that, which is a good question, although there's a chicken and egg situation. So normally we're being asked to say, hey, what are the indicators and metrics that would suggest a lower risk and thus be suitable for a lower cap rate or some sort of discount down the road? The interesting part is what we often talk about is GRESS wasn't built to answer exactly that question. It could be like you could reweight the components to better predict the cap rate, or you could reweight the components to better predict financial outcomes. But what they were designed to reflect was relative importance of environmental and social and governance issues as exogenous, as material non-financial metrics. So there's a bunch of, I guess there's a very long answer to saying, no, we're constantly focused on this issue about, can the data be interpreted to look at risks and opportunities and thus inform that risk-adjusted return? We as from my GREST experience, rarely see it rolling the other way. So it's that the rates and the discounts are a function of what we see in the project. However, there's an increasing desire to bring those together in an integrated analysis. And we can talk about some of the reasons they're hard, but the fundamental reason is the right party rarely has all the elements to conduct the analysis. And so it's hard to stitch them together while preserving confidentiality and getting things working on the right time frame. So good question. Sorry, that was a long answer, but I think actually whether Kathy or Eiley, I know you're both on the front lines of, hey, who gets what for what?
Yeah, exactly. And it's tough. It's tough for the teams that are assessing transactions and opportunities, how to look at it. I think we started to touch on this, but we think it is good, solid real estate fundamentals first, and then, taking that lens of sustainability along with all the other risk analysis and getting very localized in your asset and understanding what those future buyers might be looking for, it is key. And that, there isn't a magic set of KPIs that you can drop into your discounted cash flow. It's a bit of feeling that each case is going to be unique, and looking at how you might approach that is the best I can say. And I don't know that we'll get to a magical formula.
Well, maybe thinking about another area that we haven't covered in detail here around social. So, when I look at appraisals and business cases, it's no surprise that when we talk about energy, which has a strong link to cost and capex, it's easier to put some numbers in a spreadsheet to think about, what are some of the KPIs and metrics that are coming out. Social, it's much harder, not impossible, but it's certainly not as mature as on energy and carbon. Yet it's much more common to hear people give the go-ahead for social initiatives without having to go through some of the rigmarole that we do in big capex spending. I mean, Eiley, it'd be great to hear, how you navigate that area in terms of the social factors that you feel are important to really drive demand in your assets.
Absolutely. It may not be as sort of visible and relevant, but I think certainly, coming out of the COVID-19 pandemic, it's really highlighted the importance of health and well-being in our buildings. And it's really the foundation of how the occupants and tenants of our building feel safe and comfortable in the spaces that we're providing to them. We're really seeing this movement in the flight to quality. And, we're hearing that from our research and investment teams, that this is a consistent trend across the market, across many asset classes. And this is also playing a huge role in the return to office strategy as well. Landlords are investing big dollars in enhancing the quality of their spaces to make them really, a destination that employees want to go to. And this is definitely impacting, the B and C class office buildings in, many markets, which is putting them at risk of obsolescence. So, we're seeing a lot of investment in the amenitization of spaces to upgrade buildings to include more collaborative spaces, health and well-being features, access to healthy foods, a lot of those really important fundamentals to the people that are occupying our spaces. And in terms of how we're actually measuring that and seeing the benefit of that, it's certainly through tenant engagement and tenant satisfaction survey scores. That's a primary indicator that our asset management teams use to understand, how are the tenants enjoying those spaces? What are areas of improvement that they need to be focused on? So that's really been a primary indicator for our teams. And so that helps us to then engage further and understand what those needs are, so we can, adjust the strategy accordingly. So I would say those are a few of the key social factors that we're seeing integrated into our strategies.
Maybe Ed, can just add one quick thing to what Eiley just said. Ed is saying one thing about the social factors writ large, very much in line with what Eiley said about asking in terms of tenant engagement or whether basic measures. I actually think that our policy environment, things like building performance standards, we have to implement as we respond to mandates on things like energy efficiency and reduction in emissions. It becomes essential to do what Eiley was just saying, engaging with tenants, because the policies themselves are creating an incentive to manage energy and emissions in ways that may override tenant comfort and so forth. And if for folks who think, that's not really our thing, that's exactly what our industry does. Like if you go back to the 70s, when pressed, our industry is willing to on balance, nobody in particular, but on balance, is willing to compromise tenant comfort and safety in the interest of operational costs and efficiency. And so we have to overcome our historic lineage on this and overcome a policy environment that is only pushing on one side of the equation. So I would argue that the things that Eiley just said are actually essential to achieving to maintaining asset value in the face of these aggressive new regulations. Because we need them to be efficient, but our tenants demand that they are safe and comfortable. So Maslow hierarchy of needs, got to make sure what's on the bottom and what's on the top. So anyway, just wanted to share that perspective.
That's great. And maybe that's an interesting sort of segue in terms of, how we get better and what forces are driving people to take action, whether it's on this market forces, it's regulatory forces, other forces that are getting there. And I'd wonder, Kathy, you've got a diverse, global portfolio. If there are lessons that can be learned, so in the room here, we've got mostly people, we've got everyone based in North America, but we do have a global audience and you have global portfolios. Are there lessons that can be learned from other regions in relation to driving demand for sustainable buildings?
Yeah, it's interesting because as we look around the globe, we definitely have seen more demand for sustainable buildings in markets like Europe, for example, and even a growing demand in Asia. And a lot of this is fueled by regulatory support, mandates that are kind of pushing the market and quickening the functional obsolescence of assets that can't meet that transition. And so we do see that pushing the market forward. It's not dissimilar to some of the US markets, and Chris was touching on this, that have, more progressive goals for cities and even states that have building performance standards that will kind of push our industry to meet the call, right, of energy efficiency, decarbonization. And so we do see some of that as lessons learned, but I think it also comes back to this topic of transparency and how does the playing field get leveled maybe a little bit through certification programs or signals to the market, be it investors or tenants, that this is an asset that you can expect a healthy environment. You can expect energy efficiency. You can expect to be comfortable in this asset, because there is a component, Chris and Eiley were touching on this, of consumer preference that is not going away on this topic. And so I do think that will help push things forward. I know the US gets knocked around a little bit for taking different approaches to things, which that's what makes us great, right? We're a quilted fabric of personalities in the US. But one of the things we have going is the Energy Star program, which is a great, voluntary program that helps with transparency, and it certainly has been an important part of real estate owners and investors trying to get to that level of transparency that can help move the market forward. So I think it's a lot of back to data transparency and consistency is what will help move things forward.
It'd be curious to hear. So as you say, with the Energy Star, it's got broad coverage. It provides that consistency, certainly within local markets. And then we have additional, more outcome-based building performance standards. So here, where I am, Local Law 97, you've got other examples across the states. It'd be interesting to hear from you as well, Eiley and Kathy, in terms of how is that legislation hitting how you consider your assets, and whether or not you think there are premiums, or is it discounts? Is it driving, exit and investor decision making, or is it leasing and tenant, or any combination of those? But are they having the outcomes that they're intended to have? And if not, what do you think might need to change?
Yeah, there's a lot to unpack there. And again, I think it definitely differs, market to market. But I think, kind of honing in on maybe the example of New York and Local Law 97, it's still very early days with this regulation. And, the number of transactions that we're seeing in the market, we still need to get a bit more market data on exactly what's happening and how landlords are responding to these fines and how they're, being baked into, the underwriting of these assets and the valuation. I think we're still a far away from any green premium on assets in the market. Everyone, is looking to pay market price for that asset. And I think we're seeing lean more towards a brown discount. So I think that's definitely the trend. Like I said, it's still early, but even looking to our friends in Europe, it's very localized in terms of where green premiums are being seen, whether it's in like the London office market with those very high quality assets. We're not really seeing that consistently across the market. So, I think there are some lessons to be learned there, as Kathy mentioned, but I think where we're really seeing is tenants are also becoming more educated and sophisticated on the topic of local regulation and financial penalties. And they're, working with council to build in appropriate language to protect themselves and in their lease agreements at the end of the day, in terms of how can these fines be passed along? How can the cost to invest in these assets, the CapEx required to bring those assets up to, market standard, how are they being impacted by it as well? So I think that's where we're seeing the tenant piece come in a bit more into the regulatory scenario.
Curious to hear if you have anything to add, Kathy, and particularly if there's anything in non-office sectors. Is this drifting through the different asset classes, or are we still primarily talking about Class A trophy office assets? What's your view?
I think you definitely see it in Class A trophy office. I would say it's more subtle in other asset classes. If you have single tenant industrial, they may be looking for a very efficient building to occupy. You may be seeing some preference there, subtle preference for tenants as well in the multifamily space that, maybe you can't pinpoint that they picked your place over another place. I think it gets back to, um, that purchase decision of looking for comfort and well-being along with what is affordable. And so it becomes an ultimate component of the buy decision in terms of multifamily, but too early days to say that there's definite trends, that we're seeing that sustainability is leading that purchase decision for renters. I think, unfortunately, we're in a time where it's what can I afford, what is safe and reliable, and then the other bells and whistles come in.
Right. Chris, it looks like you're about to say something.
Yeah, I mean, I'll just chime in on top of that as saying, look, I mean, I think one of the things that's great about working in this industry, that when it comes to sustainability and ESG or sustainability and what we do, is at the end of the day, we are trying to create differentiation around real estate that is more efficient, more resilient, more valuable to tenants, whatever we put the label around that. And there is still a lot of room to maneuver in that space. And the thing that makes me kind of come back is that I think that tenant expectations for Class A green space are very high. Meeting those high expectations earns you market rent. That's what it does. And the further you are from meeting those expectations, you are at a discount when you are inefficient or risky or unsatisfying for the tenants. And so I think that this sort of decades-old quest for that premium thing is increasingly misplaced. And it's, or at least it's if you can find it, it's, as Eily said, you're looking under a special rock. But the general paradigm is high expectations and then a ramp of discounts downwards. And I think the challenge, Ed, that you laid out in terms of regulation is, what is the theory of change of that regulation? Is it doing it? And I think if you look at everyone talks about Local Law 97 for obvious reasons. It's the gorilla in this thing. However, its theory of change is taken at face value. It's a fairly regressive law that takes a very myopic view of what real estate is for, like basically reducing energy use intensity regardless of the economic productivity of the asset. So, and it creates a very weird situation, even in our best case scenario, where the exact same asset in New York can be very risky, but in Hoboken, it's great. So we've created kind of a weird world that is hyper fragmented, whether that's happening at the level of New York versus New Jersey or 50 plus taxonomies. That's a freaking nightmare. And the idea that say 40 or 50 US jurisdictions have BPS out of 3,000 jurisdictions. The question is, how does this theory of change scale out? What are we trying to do? And I do think this is a bit of a come to Jesus moment when it comes to the theory of change behind the regulation and confronting it and saying, is it working? And what did you think it was doing? And because there is another thought about BPS, which was the goal was to create that the point of doing all this was to create enough confusion around different jurisdictions to drive federal action to sort it all out. Well, that's not going to happen. So the question, so what do we do now? So I think Europe is having a what do you do now moment of are you speaking the right things to the right people? So I think maybe a tiny little silver lining of this moment is really asking, what do we think, what is the glide path and evolution of the adoption of these regulations, both within the jurisdictions that they exist in and across the broader marketplace? So just wanted to air some of those things. So I'm very bullish on our core real estate value proposition. I am very skeptical whether we have the theory of change worked out for some of these big, guerrilla regulations.
So I think the theory of change absolutely needs to get solved and become more consistent. But what about the practicalities of change? Because all of these things around improving efficiency, having more resilient assets, achieving those high expectations, it's going to cost, right? So there needs to be people within the capital markets that are prepared to, or encouraged to incentivize change and see the benefit that comes with it. It'd be interesting if we have any thoughts to share around the lending community around, are they doing anything to encourage change? Where might they be doing something? What else needs to happen? And maybe Chris, with the upcoming debt assessment, it'd be interesting to hear Greg's perspective on what is your theory of change with that assessment.
That's awesome. Okay, so I'm sorry to talk too much, but I'll give you two answers. One is the reason that GRESP exists, and it's often we evolved into a reporting framework, but what we were from the beginning and underneath the hood is a theory of change to improve how operating platforms are managed over time, and to give a way to compare, benchmark, and track that improvement over the course of an investment engagement. So just to say, hey, theory of change wise, we think that sustained engagement between investor and manager makes companies better through iterative conversations over time. And so that's the core. Now, debt providers and lenders are special. This is our second. So we started with equity and indirect equity, not even just equity. But the issue with debt is special. We tried it 5+ years ago, and it didn't scale for us. We tried it with a group of lenders who were predominantly bank lenders and traditional real estate lenders. This time around, GRESP has kind of taken another swing in partnership with a group called the Debt Roundtable, or the Lender Roundtable, a group of primarily non-bank lenders, private lenders in this emerging private lending space. And folks like PGIM and a number of other leaders have been working with us on a year-over-year basis to create a lender assessment that is designed specifically for the needs and circumstances of lenders to understand their own practices and ultimately to extend to what they should know about their borrowers. So we're basically trying to meet lenders where they are, to basically provide a way for lenders to learn about best practice, to raise their own internal practices, and to ultimately communicate more effectively with borrowers and to understand their book better. So that is what we are trying to support as another engagement. But I want to turn to Kathy, because this is something that the PGIM community, as well as more than 24 other institutions, are helping us define, what it means to be good lenders and effective lenders. Kathy, can you say a word or two about your experience and your motivations?
Sure. So on the equity side of our business, we've been longtime participants in the GRESB benchmark, and so the prospect of leaning in as a private lender really afforded an opportunity to open the door to establishing a benchmark, which is important to our debt investors who are also equity investors and want to understand how we're looking through the borrower to the collateral. How are we protecting them against risk, and how are we engaging with borrower on important matters like fiscal climate resilience and transition risks that our borrower may be faced with, and we as their capital provider can help them find mitigation to those risks, find capital to reposition their assets, or whatever the case may be, or just help them with best practices. So the spirit of the benchmark is something we're certainly intrigued in. It's something that we're big believers of having capital in the market at all times, and being a lender of choice. And being a lender of choice also means being there for your borrower to help them in a city like Washington, D.C., where they may be facing transition planning that they need to do around assets. And so we're excited for the prospect of what GRESB is putting together.
Fantastic. Well, I think given the week that we've had in the globe, particularly the global equity markets, and given it's only Tuesday, and then what's happened in the last hour, it seems to be going slightly better. But it'd be interesting when we think about tariffs, which are top of mind for everybody at the moment, and particularly how it relates to our short-term and longer-term thinking on real estate. And if there's a big if there is any opportunity that might come out of it. I know, Eilidh, there's been discussions that you've had internally around how you think about the impact of tariffs on your investment planning and strategy. What can you share in terms of those that thought process that you're having?
Yes, absolutely. This is one that definitely is hitting us on both sides of the border. I am Canadian, in full transparency, so we're definitely feeling it. But speaking with the investment teams, we're just seeing significant supply chain disruption, and we're seeing an increase in construction costs and general uncertainty around how this is going to impact pricing in the long term. And I would say our investment teams are taking more of a conservative approach to buffering in extra costs and timelines on these projects, even, when looking to purchase things like HVAC units or, construction materials for our developments. It's definitely having an impact. I would say development activity generally is reduced, just given the uncertainty, and the pipeline is slowing down in certain markets because of this, due to the rise in construction costs, and also due to just general uncertainty with immigration policy and asset demand. So, I know that your question was around opportunity for sustainable value creation, and I've kind of highlighted more of the risks. But I think there's, we're still early days in all of this as well, and just understanding the longer term implications. It's quite difficult to plan around when, as you said, things are changing by the hour. So, it's important that we remain engaged and aware of what these impacts are. So, we're building in sort of the mitigation measures to around these changes. As it relates to value creation opportunities, I think we're still figuring it out. Kathy, maybe you have some ideas as well.
I will just say the current environment exacerbates what already was a tricky environment, where managers and investment professionals were focused on the fact that values had just reset, that it felt like we were just popping out the other side. And then, to have a little bit of disruption makes it more complex. It kind of goes back to a few things we were saying earlier about picking and choosing your spots, being really wise on where you're expending CapEx, and looking at where you get that strong return, and kind of sticking to your fundamentals becomes all the more important. But I will say, well, it's hard to say where the opportunities are. Whenever there's disruption, there's opportunities. So there's probably some opportunities out there, and we just need to kind of navigate the next short term to figure out what those look like.
Maybe I'll just build on what Kathy said, or what Kathy and Eiley both said. I mean, there's nothing in this current environment that lowers costs. At least there's okay. I'm betting for not that, unfortunately. So all the things Eiley said about supply chains and marginal costs, these are all going in that other direction. If there is to the point of view that Kathy was just making about where does it create opportunities, I'll kind of go full Jigar Shah for a half second. Is that Jigar is the former director of the Loan Programs Office at DOE, has a very nice podcast, and this week they focus on kind of what's next after the net zero era, and talking about the implications of energy security in a more fragmented world. I'm going to share a link to it, because I do think you're looking for a silver lining and who's advantaged in an energy security driven world. It's a pretty good take. And the last thing I'll say is I do think that there is always a yin and yang in the universe. And one of the things we've seen is that maybe even a few months ago, opposition to sustainability or ESG in certain corners was rising. But now in some places around the world, and I'm kind of looking at Canada, I'm looking at Australia, there's being pro sustainability, even pro ESG, can be seen as an opposition to a current policy regime. And I think you can see that in the swings in some of the elections coming up. I was in Australia earlier, and it certainly is some of those trends are breaking the other direction about what we thought was going on 6 or 8 months ago, 6 or 8 weeks ago. Everything is accelerated these days. So just wanted to share that I do, there's no missing the volatility. There is no missing the upside in costs, but there is a what's next, and I guess we're kind of beginning the process of figuring that out.
For sure, that's going to take some time. Thanks, Chris, for sharing that. I'll be sure to look up. And Kathy, thanks for sharing your thoughts in terms of what we need to focus on next in terms of fundamentals and how we bring some of the consistency back. So I appreciate we are getting towards the end of our time, but I mean, Eiley, with any sort of final thoughts from you, as we just heard a bit from Kathy and Chris there, in terms of any other changes that you would like to see, if you had a magic wand, say, what are those changes that you think would help you to lead to greater change at a greater scale?
Yes, I would say it all comes back to data for me, whether that's asset level data or more market data. We've really, belabored the office business case for sustainability, and we need to look beyond that to other sectors to kind of help prove out these points. So, focusing more on industrial, multifamily, or other alternative sectors is going to be really critical. We just need to understand how this is also impacting valuations and have more consistency in how our assets are being valued and the extent to which sustainability factors are being included. So those would be my key changes.
Fantastic. Well, thank you to all three of you. I want to make sure that we finish before the top of the hour. So, massive thanks again to the three of you. Thanks to GRESB and the Aurora team for helping to organise this. And I think, in terms of my takeaway, we've certainly heard some great evidence that, this is sustainability. It's not a trend. It's not going to go away. It is part of long-term success. It's also nothing special, is it? It's a risk, just like any other risk, and it needs to be considered in that vein. And, in some markets, as we've heard, even down to some assets, the risk is going to be higher and needs to be treated, as such. In other locations or for other stakeholders, it's going to have a lower risk rating and it may have a different discussion. But, the fundamentals around both of those points is that you need to understand what the risks are and also be rational around the outcomes and how it relates to value creation. Consistency was something we heard consistently. That's good English. And the input to that really is good data. So I think my takeaway from this for everyone here, but everyone listening as well, is to think about how, collectively we can share more data, more insights, more stories around the things that work, around the things that we love to do. And, do share that with me. I'd love to read all these insights, and, do get in touch if you'd like to speak further. So a final thank you to Eilidh, Kathy and Chris. And I hope everyone has a great rest of the day.
Thanks, Ed.